Hello everyone, and thank you very much again, and welcome back to my videos. Today I wanted to talk about one thing and then want to add to something I spoke about, which is the reverse split last time. So I have somebody send me a message and wants me to know, he does not know what is shorting the stocks mean. It's his first time hearing what is shorting the stocks. So let me explain to you what is shorting the stocks is, which is a lot of people use it, and I do use it through my trade. Shorting the stocks mean if you're watching, for example, your stocks, certain stocks, they get to the highest level. So when they get to this high level, their choice is to come down. So many of the stocks you see that they go so high and they go down, and that happens continuously. So a lot of people, the people know and buying and selling the stocks almost on a daily basis or weekly basis, they do watch these stocks and they shorten the stocks, meaning they bid in the stocks is going down and they buy it, buying the stocks knowing this stocks is gonna go down. So that's what they're going short in the stock. That is, I am shorting the stock. If this stock's $100, I'm shorting because I think it's gonna come down to $90. That is what is shorting the stock. So people buy that, and mostly with companies that they have history, that they've been watching these companies. And I'm telling you exactly how I do it, because I watch a lot of companies, and when I see that is the first time it went too high, then I shorten the stocks. I said, no matter what, it's gonna come down. And so when it come down, you make money. That is what is shorting the stocks. The other things, which is I was asked a question again, why do people do reverse split? What is the advantage for the company to do a reverse split? If they were trading as $1,200 a share, why now they're trading at $120? Why would anyone want to do that? Well, I'll tell you what is the difference. Why people, they do the reverse split, or I would say why companies do a reverse split. Like I said before, the reverse split is when the company goes, for example, to a high volume, then it will have a limited investor buying these stocks. The healthiest companies in the stocks market is the companies they have a huge volume every day. The huge volume every day, it's mean the buyer and the seller buy and sell. It's a humongous. If you go to these big companies, from Apple to Tesla to Nvidia to IBM, Micro, all of that, you will see a high volume every day. People buying and selling the stocks, 40, 50 million shares trading or buying and selling. So that's what makes the company healthy. When you take your company public, the stocks market, the stock exchange commission required to have minimum 400 shareholders. So these 400 shares they can buy and sell and keep the company healthy. So the more people they buy your stock, the healthier the company is. So when a company get to a high level, and now it's, for example, they're doing their stocks is the 1,200 or 1,000 or 1,500, and they do a reverse split. They do a reverse split because they want to get the stock. Let's assume, like what, for example, Netflix was trading at 1,570. They did the reverse split 1/10. May reverse the stocks 10 times, whatever it is. So if it was trading at 1,500, they did the reverse split. Now it's 150. With 150, they're bringing more investor to buy, because the other, when it was at 1,500, it was limited to the high net investors. Now an average investor can buy $150 a share, because he knows if he wait for a long time, which is a good investment, that is, the stocks is going to go back again to a highest level, or maybe 300, 500. It will go back again like it was before. So when they do the reverse split, it'll bring the stocks down. You will lose. If you have, for example, 1,000 share, then it will become 100 share. If you got 1 million share, it will become 100,000 share. But the value is still, you don't lose no money, but it's the value of the stocks or the amount of the shares will reduce. So that's why when they do it, so the company benefit out of it, because it'll bring a lot more investor to the company. and it'll keep the company always going, because the more volume you have, the healthier the company is. I hope I cleared that to you, and next time I'm going to talk to you about the IPOs, the new IPOs coming in 2026, or actually what is really your for the big investor, how you should manage buying or get involved in the new IPOs coming in 2026. I'm doing just not finished my research yet, but I'm going to talk about it next video, if God willing. Thank you all very much. Look forward to see you all in the next video.